So even when the opportunities of profit booking comes, you will never be able to book the profits. And that is one of the key reasons why retail investors lose money. Hi everyone, welcome to today's video. So according to a study done by ISB, approximately 20.2 lakh retail investors make 0% return in the stock market. Now we are not talking about 1 year or 2 year or 5 year data. The study says that they consistently make 0% return in the equity market. Now, if you take a look at any other study, for example, here is a study that was done by a mutual fund, so take it with a grain of salt. They said that, the equity mutual fund managers, they make roughly 15-16% returns. But the worst performing group of people in the stock market from a return perspective are again retail investors. Of course, we can debate the exact numbers, who has done the study, this, that. But to cut the long story short, all of us would intuitively understand the fact that retail investors do very, very poorly in the equity markets. Then comes the natural response that, okay, what is the point of learning about stock market, doing all that jig, getting up in the morning, having like heart attack about market going down, market going up, this, that. I will just simply give my money to mutual fund managers or some other third person who will manage my money. And in case they are not able to make return, I will blame them. So that is the philosophy with which many of the retail investors operate. Now, please understand the math, and this is one of the most important and critical things that I will tell you. So take a look at this chart, and here we are assuming that you are a retail investor and hypothetically you are able to invest 25,000 rupees a month in the equities market. Now, generally speaking, if you're doing index investing or if you're doing mutual fund investing, then studies suggest that you will make roughly 12% return. Then this is the meta study that I'm quoting to you. So after 10 years, it will come out to be roughly 58 lakhs. Now let me show you second chart that if you learn about stock markets properly, if you avoid the few critical mistakes that I'm going to subsequently explain, and let's say hypothetically for the time being that you can make 15-16% returns, then what is the corpus according to the same calculations? You will end up making roughly 74-75 lakhs. So again, you will have the same theory that, what's the point of doing this jig and, getting up in the morning, tracking the stock market, reading news, this, that, because the difference between 60 lakhs and almost 75 lakhs is not that much. And you are absolutely right. But see, here is the thing that if you are even 30 years old or 40 years old or even 50 years old or even maybe like 60 years old, the chances are that you are going to invest for the next 25-30 years, right? So if that is the scenario, then you need to understand part B of this math, and let me show you the exact same calculations, just changing the timeline from 10 years to 30 years. And this is the data that we get, that if you are growing your money at 12% CAGR for a period of 30 years, then you end up making roughly 8.8 crores. But if you change the calculation, and here we are only changing the return from 12% to 16%, then your entire corpus becomes almost 2.5-3 times. So the entire debate that 1-2%, 3% ka to difference hai, what's the big deal with this 3-4% gap? Well, it's almost 3x your portfolio in your entire journey of investment. And therefore, I urge all of you that you learn about stock markets, because on the face value, the difference between 12% and 16% does not appear that much, but it is creating a massive impact. Similarly, when you go and lose money in form of commissions, that okay, 1% यहाँ निकल गया, 1.5%, 2% वहाँ निकल गया, क्या ही फर्क पड़ेगा? No, it creates a lot of impact. So now you will have a natural question that, you just showed us these studies, retail investors lose money. And here you are speaking about the fact that 16%, 16% return you will make, this, that. So how is that possible? What are some of the things that I can do in order to make that 16% gain? Well, see, I cannot guarantee you that you will make 16% returns. But let me speak about 5 critical mistakes, and if you avoid them, then definitely wherever you are standing right now, you are going to make much better returns than that. Humble request that please consider liking these type of videos so that more retail investors are able to understand the nuances of investing. So the first key reason why normal retail investors lose a lot of money in the stock market is due to something called as churn rate. It very simply means that if 100 new retail investors are entering in the market in 2023, 90 of them will take a loss, 10 will remain. They will probably work for another year. Then 5 of them will take a loss from there. Then 5 will remain. And after 5-6 years, then out of those 100 retail investors, maybe 1 or 2 will survive. So that is called as churn rate. So if you are a boy in India, then most likely growing up, you would have played cricket. And all of us, when we start playing cricket, when we are like, 5, 6, 7 years old, our dream is to become like Sachin Tendulkar or Rahul Dravid, and these days Virat Kohli, etc. So what is the theory there? That again, it's that same churn rate theory, that almost every boy in India plays cricket, But at the end of the day, then there are hardly 100, 200 professional cricketers who end up making money. So the churn rate is exhibited cross sector. This applies especially in the stock market. And the point to be noted here is that as normal retail investors, if you don't want to lose money, then you must focus on the longevity. Longevity simply means that don't be like a barsati mendak that okay, today I will experiment with the stock market and I'll make a little bit of money and then dekhenge ki kya karna hai. No, at least have like 10, 15, 20 year vision in the stock market. At least go in with that intent. You don't need to make all your money in your college itself that okay, first year I start learning trading or investing and I want to make all my money here only and I will beat Mr. Warren Buffett also. No, it doesn't work like that. Now, another way of contextualizing this churn rate to the world of finance would be to understand the difference between Mr. Warren Buffett's style of investing and Jesse Livermore. So Jesse Livermore was a professional trader and during the 1930s crash, he ended up making crazy amount of money. His net worth would have run in billions as per today's purchasing power parity. But his career was short-lived. In another 8 to 10 years, he committed suicide because again, he was adopting that fast style of investing. He lost a lot of money and unfortunately, he had to commit suicide. Now, on the other side, you have a legendary investor like Mr. Warren Buffett. What he ended up doing was that he made roughly between like 15 to 20% CAGR. I'll have to get the exact data. But the length of time he made those returns, that was truly impressive. That he was able to churn that 15-20% return over and over and over and over again for decades after decades. Exactly due to the fact that it was not as if that, you know what, that he's like making crazy return and beating everyone. He makes decent amount of returns which ranges in the tune of 15 to 20%, but he has been able to build that investment strategy and apply that over and over and over again. Now, I know many of you would be thinking that, you know what, Warren Buffett is making like 15-20% return and here you said that I can make 16% return. See guys, I'm talking about that you making returns in India because I'm assuming that majority of my audiences are Indian audiences. Now in India, making 15% return is equivalent to making like 10% returns in the US. Why is that the case? Because Indian rupee keeps on getting depreciated by at least 4 to 5%. So please consider these factors as well. So the first key thought that you need to have in mind as a retail investor is that build a strategy where you can sustain for a fairly long period of time and you can avoid that churn. Now comes the second reason as to why retail investors lose money, and that is called as disposition effect. Now, disposition effect has come out in different formats and ways, and different investors have created their own sayings around it. But in very simple, easy to understand language, it means that, for example, let's say that we buy ITC stock, it starts running, and then what happens is that 15-20% gain ho gaya hai. Let me go and sell it. And majority of us end up selling it. So as a result, what are we doing? We are selling our winners. On the flip side, what we do with losing stocks? For example, XYZ stock, it falls by like 10%. Then what you will think, yaar aur khareed leta hu, I'll buy and downward average it. So you'll buy more, then it falls more, then you buy more. Then you keep on buying without considering the fundamentals behind it. So the disposition effect simply says that you're cutting out your winners too early and you're aggregating more and more and more of your losers. So this is something that retail investors frequently undertake, and as a result, they end up incurring a lot of losses. So in order to avoid this, there are 2-3 tips that I would like to share with you. So first and foremost, please consider the fact that whenever you are taking entry into a particular stock, or if you're considering to sell a particular stock, then you need to know the entry and exit points for every stock. Now, what do I mean by that? Can I show you an example? So 100% yes. So these days I'm building more positions on Nifty IT. And in case you want to get information around these type of things, why am I doing it? When exactly am I buying? What level will I sell? You could consider joining the YouTube paid membership community. The membership fee is very nominal and I talk about whatever I'm buying, selling, why am I buying it? I explain my entire rationale. So you will be able to pick things fundamentally. So let's say that you're considering buying Nifty IT today and you are able to build some position on it. Now, at what point will you exit this stock? Now, I can at least think of 2 ways of exiting this stock. So first clear pattern that I am seeing is called as reverse head and shoulder pattern. And according to this, we get a very clear exit point at roughly 35,750 levels. So that is where I plan to exit Nifty IT in case I'm buying it today. The second level that I can think of is the recent high level. So for example, here I can clearly see that the recent high was roughly 39,000. Now, depending on the market condition, that how the entire market progresses, how US tech stocks are behaving, I might update my thesis. But while taking entry into IT Nifty right now, I have a very clear exit strategy. Now that strategy can fail because the market circumstances can change. But if you have no clue at what level you want to sell Nifty IT, you will buy it. You will keep holding that and you would not know when to exit that. So even when the opportunities of profit booking comes, you will never be able to book the profits. And that is one of the key reasons why retail investors lose money. The second key strategy that can help you deal with the disposition effect is that you need to consider your overall portfolio returns, not individual stock portfolio returns. I cannot tell you how many messages I get here, Akshat, this stock mein loss chal raha hai, right? I purchased like this HDFC AMC, or I purchased this particular stock and I am at a loss right now. What should I do? Should I average it down more? Why do you want to average it down? By the way, I'm not saying that HDFC AMC is a bad stock or something. I am still holding it. I'll make a separate video on that topic. I just bought HDFC AMC as an example. So let's say that you purchased HDFC AMC. You thought that everything is good. You will continue to hold it. But unfortunately, the stock fell. You did little bit of downward averaging. Downward averaging means that, for example, HDFC AMC was at 2500 rupees. It fell to 1800 rupees. You purchased little bit more. So this is called as downward averaging. Then let's say hypothetically it fell to 1200 rupees. Are you going to buy more or are you not going to buy more? So here what you need to consider is that you need to make portfolio level decisions. You need to consider your overall portfolio ki kitna return aapka total from the portfolio is coming, not from one individual stock. Don't get obsessed of making and converting all your losses into profit from one individual stock also. Which brings me to a related point here, that please find the most productive use of your capital every single time you put money. What's the meaning of this? This is a complicated statement. So let's say that today you have 100 more rupees to invest in the stock market. Now, what are the choices that you have? You can go and buy a new stock. You can probably go buy an index. You can go and downward average your stock. Or you can even go and invest in the US stock market or in some other asset class. So which choice will you make out of these 4 or 5 choices that I have presented to you? You need to make this decision independently. In economics, there is a concept called as dead weight loss. Dead weight loss simply means that, for example, let's say that you went to meet your friend and your friend did not show up. You took the bike, you burned all your petrol to reach some destination to meet him, spend like 30-40 minutes, whatever, right? That time is gone, that petrol is gone, you can't do anything about it. So that thing is a dead weight. Same thing happens in the stock market. That, for example, if the stock price has fallen from 2500 to 2000 rupees, that 500 is a dead weight. So please don't do anything with it. Your job is not to make return from every single individual stock. Your job is to keep your portfolio in green and make money on your overall portfolio. So with that said, let's move to point 3. Now the third reason why retail investors lose crazy amount of money is that we get married to specific asset classes. Now let me utter the word crypto. Now the moment I say it, there will be like 100 people giving me galiyan that, okay, crypto, this, that, why, what is your issue? Your goal is to make money from all the asset classes. Whatever allows you to make money, please do that. Please learn about that field. That is my humble request to all of you. But I see so many commentary that, even like crypto people, they keep on fighting with each other. No, Ethereum is best. No, Bitcoin is best. Same goes for stock market people that, only stock market is the best. Same goes for real estate people that, okay, real estate investing hi hoti hai, baki kuch nahi hota. So people are just fighting and infighting. On the flip side, the economics teaches us that the market circumstances change all the time. Please think about it rationally, and it is very simple. For example, right now, let me give you an example that these days I'm purchasing real estate more. Now, many people would say that, you have lost faith on stock market. Stock market's a return nahi ban raha hai, isliye you are purchasing real estate. Okay, so let me explain you the economics behind it. So what is happening in the real estate market right now? That right now, EMI or equal monthly installments that you pay on your home loans, it's almost touching 10%. You tell me in the comment box whether it is true or not. And this data can be verified with any bank that you have a home loan with. So EMIs are very, very expensive right now. Now, if I'm sitting on cash and if I'm going in the real estate market trying to buy a flat or trying to buy a land, trying to buy a villa in Goa or whatever, then do you think that will I be getting good deals or not? The short answer is yes, I'll be getting good deals. Now apply the brain why. The reason there is very simple, because right now the home loan rates have become very, very high. So what will this do? There will be only very few buyers because almost all of us purchase real estate on loans, and that is a sensible strategy also. But since the home loan rates are very, very high, very few people can actually afford to buy real estate. Now what is happening from a supply demand dynamics? Now the supply of real estate is somewhat constant. But the people who are looking to buy real estate right now, they have come down. Why? Because again, due to this very high interest rate and EMI payment issue, people cannot even service their EMI. So do you think that I'm better off buying real estate now, or should I be buying real estate like 5 years from now? The right answer is that if I have the cash and if I can service my EMIs, then it makes a lot of sense for me to buy real estate now. Why? Because I will be getting very good deals in the market. So same applies to a bunch of different asset classes. The larger point that I'm trying to drive home in the market is fairly simple, that the market circumstances, dynamics change. Now just for context and to clarify the entire thing, majority of my money is still in the equity market. It is not in the real estate market. Even in that, majority of my money is still in the Indian equity market. So it's not as if that I've lost faith on the Indian equity market. Not at all. But right now, I do see the fact that there are very good real estate deals which are coming, and only a handful of buyers can avail those deals. So therefore, I'm considering putting some money in real estate. So that is the perspective with which I operate, that if the situation is good, you go and invest in debt if it makes sense during that juncture. If it makes sense, invest in real estate. If the market and data is telling you to invest in the stock market, invest in the stock market. Please do not get married to an asset class. Then comes the fourth point as to why retail investors lose money in the market, and it has to do with the concept of accountability and holding others responsible. Now, these days, the markets are slightly soft. For the last 1.5 years, markets have not really given a run up. So as a result, influencers and finance influencers are taking a lot of heat. You can criticize me, you can criticize other influencers, no doubt about that. But see, think about it this way, that would criticizing other people and making them accountable for your money, is that the right thing to do? That's A. Second, is that going to help you? Our job should be to learn anything that the other person can teach us. Just because you are hearing about a particular stock from me, I keep on saying that please don't go and work on that strategy. Hear contrarian viewpoints. Hear the viewpoints of 5 other influencers. Build your own investment thesis and then act accordingly. Now, this concept of accountability not just applies in the stock market, that Falana Dimka uncle said that buy this particular stock, you'll become rich, you purchase that, and unfortunately it did not pan out. So whom are you holding accountable? Probably that uncle. Now, if you are in your career, if you are not finding success, then probably you look to blame someone. Similarly, in the financial market, you're looking to blame someone. Similarly, if tomorrow you start your business and do not find success, again, you'll find someone to blame. So blaming others will not help you get ahead. You must learn from other people and then act according to your rationale. And also clarifying on the concept of accountability in the stock market, please understand, and this is something that I've said over and over again, that stock market is a highly uncertain place. You can't predict the highest price of a particular stock, even a good stock, and the lowest price of a particular stock. There are resistance support levels that get broken all the time. New resistances support get formed. Sometimes some legitimate news truly derails the stock. So from that perspective, if today I'm speaking about a particular stock X, my perspective on that can change. It is not as if that I'm changing my tune. It simply means that I'm working in an industry which is highly uncertain, and I need to update my knowledge fact set as well and communicate that to you. So please be responsible for your own money. That is a simple message that I will give you. So now comes the fifth and final point, which is a fairly important point, which is that you need to discover your investing style. Now, what is the meaning of investing style? For example, there are contrarian investor. Contrarian investor means that, for example, these days there is a lot of negative sentiments when it comes to IPO investing in a startup. Now, if you understand the space really well, you will say, yaar, ye falana dim ka IPO aa raha hai, and I'm going to hold it because I understand this space. Then what type of investing you are doing? You are doing contrarian investing. This is one style of investing. Second style of investing is called as value investing. So this style has been popularized by Mr. Warren Buffett, and there are deep value investors also. So what they look for is that they look for discounted deals. They think that, you know what, today this particular stock is there. It is trading at a very high PE. Agar gir gaya, to I'll buy it. So the PE falls. Someday they buy it in bulk. And then they wait for the stock to come back up. So their viewpoint is very simple, that I'm only going to buy stuff or even good stocks only and only when they are highly discounted. Now, if you are someone who is very good at running valuations, then doing value investing makes a lot of sense. But you don't know how to do valuation and you are still doing value investing, then it makes no sense at all. So please try to understand the essence of every style of investing. Third style of investing is called as growth investing. Growth investing means that I'm just going to buy a good stock. I don't know at what price am I getting it. I don't care. I cannot run valuation. I'll just simply identify a very good company, set a slightly longer horizon, 3 se 5 saal ka, 3 or 5 years, and then I'm going to stay put and make money on it. If you are comfortable adopting this style of investing, please do it, no problem. There is another style of investing called as macro investing. This is done by Mr. Ray Dalio, and since I have studied him from a very young age, I also emulate that style of investing. So I look at core business analysis and macro fundamentals, apply economics, and I tend to buy and sell stocks accordingly. Now, if you understand this style of investing and you want to learn macroeconomics, then pick this, then there is nothing wrong with this. Similarly, there are a wide variety of styles in investing. Now, the reason why retail investors get confused about investing and they end up making a lot of losses, that they end up mixing all these styles without understanding any of the styles. So please don't do that. So please build your knowledge set across this. You can definitely mix and match styles. There is nothing wrong with this. But please do not absorb a technical analyst's commentary by thinking that he's a macro investor. I hope that I'm able to communicate this very important point. And like always, if you need more clarity from my side, please drop in your questions. I'll try to respond to as many as I possibly can. And also, if you want to pick different styles of investing, I do teach it on my Wisdom Hatch community. Again, for more information, you can check the links in the pinned comment and description box. I hope you enjoyed this video. Do share it with your friends, and I will see you soon.